The broadcast is now starting. All attendees are in listen-only mode.
Hi traders, welcome to the live webinar with Admiral Markets. My name is Chris, and today's focus is on wave analysis, but not just a regular Elliott Wave theory webinar that is taking a look at the theoretical point of view, perhaps more than the practical side. We want to reverse that and take a look at how Elliott Wave theory, wave patterns, wave structure can help you analyze the markets, but also find trading opportunities. And that is the core focus of today. So more practical kind of element to it. Because many times traders think that it's maybe too complicated and not simple enough, but it depends on how you approach it. And you can basically shape it in a way that it helps your trading without getting too, let's say, too detailed or too dragged down by all types of different wave counts, etc. All right, but before we take a look at the remainder of the webinar, two notes. One is the fact that this live webinar is shown to a global audience but may not be suitable for everyone. Please visit admiralmarketsglobal.com, select your country of residence, and contact the appropriate entity to find out if this webinar is suitable for you. Second of all, please note that trading for exchange and global financial markets is considered high risk. Please seek the advice of an independent financial advisor for more information on that. This webinar is for informational and educational purposes only. Sorry about that. By continuing watching this webinar, you agree with this disclaimer and you are aware of the risk involved when trading. Alrighty. Good. Let's move on. Thank you for your attention on that. There we go. So wave patterns are, of course, a part of a general kind of analysis that one can make from the chart. It's maybe perhaps an important part for some traders. For other traders, it is totally not relevant. Some may be in between. But generally speaking, if we're looking at using technical analysis to analyze the charts, I think that we can agree that there are three ways of doing that: support or resistance, price patterns, and using trend and momentum. These are kind of three core pillars that I have personally identified, but I think that they are quite common knowledge. But these are at least my three pillars of analyzing the charts. Maybe more, but I think that most of the tools, indicators, methods fall within these, one of these three groups. So wave patterns, of course, is part of price patterns, right? It's a pattern. There are many other patterns around and available, but wave pattern is one of those. And it is an important part of patterns, for me at least. And they help me identify and understand the market better. So support and resistance obviously helps me spot turning spots. Trend and momentum obviously helps me assess what the direction of the chart is probably will be next. And patterns help me understand the kind of psychology behind the movements, behind these patterns, and wave patterns, of course, as well. Other patterns could be chart patterns, candlestick patterns, time patterns, Fibonacci patterns. There are many of them, of course. Wave patterns are one of those. So when we're looking at price patterns in general, basically we're looking at swings, right? Price swings, which could be either with momentum or could be corrective. So when you basically have price making a strong momentum and then a correction, that correction could be a bull flag. It could be a bear flag, for instance. That's a chart pattern that's based on first momentum, then correction. A head and shoulders is momentum, correction, 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 momentum. All right, let me make that drawing for you. Right, it would be momentum, correction, 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 momentum, like this. Right. Now you might debate if this is not maybe momentum. It could be momentum here too, by the way. So it could be that, but it would be shorter than the previous one to get the head of the head and shoulders. For instance, that would be, these are all swings. We're all talking about swings, and they build up chart patterns. So when you're doing wave analysis, you're doing nothing more than analyzing swings that are either impulsive or corrective. It's nothing more or less than that. So sometimes it seems very complicated, it seems very sophisticated maybe, or it seems too much. But if you just boil it down to the core, it's not that difficult. It's just looking at swings, and it is looking at whether that swing is impulsive or corrective, and then gluing those pieces together. So, okay, this is momentum, this is correction, this is momentum, this is momentum, this is correction. So you build a story, you build a timeline of a story, and you label and you analyze these momentum and correction swings, and then you get kind of a sequence of swings, and then that gives you an idea about what could be the next one. It's never 100%, it's never for sure. Nothing is in trading, but it gives you an idea. That's really what wave patterns are. And if you take the next step, which is analyzing waves, then you would be labeling those swings with numbers and letters. This is a wave 1 or A, this is a wave B, this is a wave C. That's it, really. You're only looking at swings that are momentum or correction, and the next step would be to label it. That's it. It's not that much, right? But doing it, of course, live, correctly, and in a way that helps your trading, that is a different story, and that is more difficult, of course, right? That's why this takes practice. That's why I always indicate to traders that are starting out with wave patterns and wave analysis, use it first as a practice. Use it just to get a feeling for it. Don't really use it that much for trading decisions as yet. Just build up experience. And the more experience you get, the more comfortable you'll feel for using this theory and using these patterns to perhaps make trading decisions. At the beginning, it's better not to. It's better to look at other things and just use this as a extra confluence, as a support. At times that you think it's clear. And if it's not clear, look at it, but don't use it. Because when traders start out, they try it, they think, oh, this looks simple, this is A, this is B, I'll trade that wave B, and it doesn't work out. And the first thing, they give up on it within 1-2 trades. Perhaps some can be that quick. So obviously you can never be that quick. You need to learn things, study things, experience things to master it, especially waves. So, but that's something as well. But this happens, and traders get frustrated a bit soon, and because it's just not a correct kind of sequence to learn it, not the correct, step-by-step method how to learn it. All right, so what do we do with those swings? From those swings, of course, as I already indicated, we build chart and wave patterns. And as I already said, you're basically looking at the last swings to get context, and then we're estimating the next swing, the next piece of the puzzle. All right, so what do we do with these waves, right? Because I wanted to make it practical. So there are a couple of things we can do. We can use it for analysis. That's always step one. Then we can use it for understanding decision zones. And when you feel ready for it and you have enough experience, you could use it for support in entries and exits, or you can actually use wave analysis fully for entries and exits. So that is, of course, the last step, the most difficult step, but there are traders out there that use wave analysis as their primary and maybe sometimes only concept or only thing to trade the markets. I don't do that. There are a few out there. It's more difficult. I think using some indicators, some tools, some other supportive resistance levels, trends, makes it more doable and easier to find entries and exits than only using wave patterns, right? So I personally don't do that, wouldn't do that. You can use it for recognizing swings, you can use it for momentum and correction, and you can find high probability spots and patterns. So recognizing swings, let's start with that, is something more about candlestick patterns. Okay, we'll take a look at that. Momentum and correction I'll explain on the chart, and how we can find high probability setups and patterns as well. So those three things we'll do live on the charts. The best wave spots in general, which we'll be reviewing, is trading the wave 2, trading the wave internal part of wave 3, trading the wave 4, end of wave 4, start of wave 5, the wave C, and triangles. All right, so let's take a look at the charts right now. And thank you, Dushan. Definitely enjoying it indeed. Good to be out and in a different environment. So absolutely, thank you for those wishes. I think that whole Europe, or not whole Europe, but a decent part of Europe is getting some warmer weather, 25, 27, and I think that Croatia is probably one of those. I would assume. I didn't check, but I wouldn't be surprised. Almost like summer at the moment. So let's take a look at the first of those items, which was recognizing swings. So I'm not going to dive into this very much, just because of time purposes. But basically, what you can do is use the awesome oscillator here, for instance, to recognize swings. So this is one swing, right? This is one swing. How do we know that? Because if you look at the oscillator, that's where the zero line crosses. So this is one piece, and here the zero line crosses, or didn't cross actually yet. So this is actually considered one piece still, because it didn't cross below the zero line actually. It was close, but not yet. If it did, I mean, it was very close. So it's debatable whether this is one swing, then this will be a next swing, and this is probably going to be a next swing. That's how you can recognize swings, but you can also just recognize it, yourself. Obviously, this is a swing. This looks like a swing with 3 swings in it, or 5 in it, then another 3 up for one more swing, right? So it's something you can do visually as well. So that's, by using momentum and correction, you can recognize the swings. By recognizing, these are the waves, basically, right? First part is recognizing the waves. Now, second is momentum and correction. When you have strong candles pushing in one direction, like here, that's momentum. You have majority of the candles are up. Majority of the upside candles are relatively large in size, and the candle closes are near the high. So you got good momentum being built up, as you can see. So that's momentum. Correction is when you have small indecisive candles going sideways. So a correction could be here, for instance. So recognizing waves helps you with that. Or this is recognizing swings, but that helps you with waves. Then finding high probability setups. So now we need to take a look at where we can find interesting wave spots to trade. Alrighty, so for instance, here, let's take a look at this year dollar. This is something I remember live, so it's just easy to talk about. For me, this was either an ABC or a 1, 2, 3 correction, and up it goes for wave 5. So if once you get a correction, a bull flag like that, to me it was clear that price could not enter in this below this top, because otherwise it would not be a wave 4, wave 1, 2, 3, 4. It would not be a 4 anymore. And if it challenged this bull flag, there was a good chance of a wave 5. So for me, that was an interesting setup, because I saw the bull flag correction in between those blue lines. So that confirmed the expected wave 4. Price made bullish candles without hitting the purple line. That was a second confirmation. So for me, it was something that was worth trading right here upon the bullish candle right there, right here. And I remember analyzing this one. I don't think I traded it myself, but I did discuss it with some traders. And but you can see anyhow that this was a good wave 4, and that the bullish candle indicated the end of wave 4 potentially, and up it went for wave 5. That's just one example, random example there. Let's take a look at some other patterns. We find a good wave 1, 2. It's a little bit more difficult, but because this is a choppy kind of corrective chart, so it's a little bit more difficult to find such a pattern. But for instance, here, if you think that this is a strong move down, for instance, right? And it's not really a good example, maybe, but here you have a push, a hook back. So this could be a wave 1, 2. And if it breaks, we can go down for wave 3, for instance, right? So trading here within wave 2 or at the end of wave 2 are also interesting setups because you have a relatively small stop loss, and if you get a wave 3, it could be a very big space. That's why those waves 1 and 2 are interesting. They're a little bit more difficult sometimes because they could be against the trend. In this case, we're having a wave 1, 2 within the trend, which is down, looking at the moving average. So we're trading with the trend, but still, wave 2 is pushing up. So you can trade 1, 2 within the trend or trade 1, 2 as a reversal, which is more risky. But generally you have, because wave 2 goes deep as a retracement, you tend to have a smaller stop loss and a bigger target. So that's why wave 1, 2 kind of combination is very interesting. Plus, you have the added benefit that if it's not a 1, 2, 3, a 4, 5, but rather an A, B, C, you still have the trade going your way. So even if your wave count could be a little bit slightly off, there's a good chance that it would still make a continuation in that direction for wave C rather than wave 3. So that's the benefit there. Typically, wave 2s are stronger pullbacks like this. All right, so that could scare you and make it more difficult. That's why sometimes waiting for the breakout here is a little bit easier for some of you, or waiting for candlestick confirmation patterns to indicate the turn and the fact that perhaps wave 2 is finished. Let's take a look at the other one. Here we have strong momentum, correction, and this could be again an example of a reversal via wave 1, 2. And if you put the stop loss below the bottom, which is the invalidation spot, then you enter somewhere here or here. Depends how aggressive you are, right at the turn or upon the breakout. But there's still plenty of space left. So that's the advantage of a wave 1, 2. Let's take a look at a internal wave 3. We already talked about wave 4, 5, but I'll show you maybe a few more. Like here, we have a pattern. Sometimes the wave 5 doesn't go too far, as you can see. It just pushes a little before you get the turn. That's because we're in a wave 5, of course, and those don't have to go necessarily that far. So that's the risk. Also, the risk is that the wave 4 turns out to be very strong very long and choppy. Look at the daily chart of the euro dollar, for instance, right? This is a typical wave 4, and it's taking forever. So that is the danger of trying to trade wave 4, is that you sometimes can get stuck in the trade for a long time, or you just close the trade for a small loss because it's just going nowhere and you get annoyed, and trustfully sometimes it's just better to exit because it's too lengthy and wait for a new potential start of wave 5. That could be the tricky part of a wave 4 and 5. Internal part of wave 3, here is a good example. This is for the moment still, I think, a wave 1, 2, 3, 4, 5. So trading this part could be very interesting, either on this time frame or even on lower time frames, right? You got a good push up. The wave 3, there was a good chance the wave 3 ended here. Wave 3 started probably a good chance that it started with this bullish candle, right? So let's mark that as the wave 3. Let's get rid of that. So what could have been trades? The break above this resistance, these bullish candles. Here was a flag, so another bullish candle here could have been traded. The break above the top, hook back and continuation right here are potential setups that could have been traded within this internal wave 3 on this time frame. Of course, we can keep trading it, but eventually wave 3 is going to finish, and that's why you want to keep an eye on the targets. And price got close to the minus 161.8 target, which is an area where wave 3 is vulnerable to a wave 4 retracement. So that's when you would want to be careful with scaling in or adding or taking setups, right? So this is a spot where the target is getting so close within the wave 3 that you want to be careful. Now within this push up, of course, there could be trades on lower time frames, like the 4-hour chart. We can try to find trades within that. Here's a wave 1, 2 again. Here's a bull flag within wave 3. On the 4-hour chart, here's a pattern for continuation, right? So those are a couple of examples on the 4-hour chart, and there could be more on lower time frames as well. So that's an example of wave 3, is that you get basically these continuation pushes through flags, triangles, and you get continuation patterns like that. All right, that's good with wave 3. You can trade those continuation patterns a little bit more aggressively if you get a wave 3, because price is expected to move further. All right. Now, how do you know the difference between an ABC and a 1, 2, 3? The difference is when price either breaks above this target or this target, because the ABC typically goes to a minus 272 target or the minus 61.8 target. And these targets can still be respected even though you're in a wave 3. As you can see with the minus 272 target, you still got a dip continuation. But if price breaks above it, or if it shows good bounces at these targets, right, then the breakout, or as I said, the continuation, is often an indication that price is not in the ABC but a 1, 2, 3. So it would have to break above these targets. If it reverses strongly at these targets, of course, then you might be thinking at it or looking at an ABC. It also depends on what is your bigger wave count. At this moment, this seemed to be more like a wave 3, also because of the fact that when looking at the weekly chart, we were looking at a 1, 2, 3, 4, 5. So we're looking at an impulsive wave 5. In that case, a 1, 2, 3 is more likely, 1, 2, 3, 4, 5 within 5, than ABC, although ABC could occur if this wave 4 gets extended, right? It's possible. But chances are a little bit more, especially if price breaks through these levels, of course, that it's a 1, 2, 3. But the break is important too, and how price moves up. Is it choppy or is it impulsive? All of those are pieces of clues and information that give us more idea about whether it's a wave 3 or not. Alrighty. So if this is a wave 3, of course, and price starts to break above these targets, then yes, you have more space on lower time frames to trade the continuation, because there is that momentum pushing price into our direction. And then I wanted to trade about wave C or triangle, sorry. So a wave C can sometimes be impulsive. Look at this, A, B, C correction. Look at this wave C. So sometimes that's interesting. I remember this one, I took this trade, I remember, after these engulfing twins on the 4-hour chart. I remember entering the short here because I thought it was a wave C, and I knew that this wave C had some decent mileage in it. If you put the fib from here to here, right, good chance of going back to the 38.2 fib, maybe the 50. 38.2 fib is a solid target. So there's this space, there's this risk. It's okay for a reversal counter trend trade. And why? Because there was bearish engulfing twins at the previous resistance, and that indicated that an expansion of wave 4 is likely. This was probably not going to be the end of wave 4. It was probably going to be later on here. In fact, in retrospect, we find out that that was only the first part of a correction. It has expanded way more sideways than that. But at that time, that seemed like the most likely scenario in A, B, C. Now we know that was only part of a first expansion, which is W. This is probably an X, and down it goes probably for a Y. All right. So yes, wave C's. If you have the space after some good candlestick pattern, I mean, you can pick the top or bottom too. You can pick the reversal spot of the wave B if you're confident that there's going to be a bigger correction. But estimating when a reversal correction happens is a little bit more difficult. So waiting for candlestick patterns to confirm that typically helps. And the last one I wanted to show you is a triangle. We can maybe take a look at, I don't know, let's take a look at the 4-hour chart maybe. and see if we find one. I mean, there are a lot of corrections. Let's try to find a triangle specifically. Sorry, A, B, C, D, E. All right, it's not the best of examples. It's a little bit small, but yes, this is a triangle. Trading triangles is great because if you know where the wave E will most likely end here, it shouldn't break below the wave C bottom. You can put the stop loss below this wave C bottom or the wave A if you want to be extra safe. And you get a very small risk, but a potentially big target because this could be added to this, and that's kind of the target you're looking at. So there you go. We didn't reach the target entirely, but you get the point, right? Pretty decent move up anyhow. So small risk, but pretty big target. Or you can trade the break, of course, of wave. Let's see, A, B, C, D, E. The break of D in this case, and you'll have the breakout. Your risk is a little bit more, but you have the advantage that you have kind of the confirmation of a breakout to the upside. You could wait for candlestick patterns to confirm that breakout as well. So bigger stop loss size, but more confirmation. If you enter at the wave E, less confirmation, but smaller stop loss size. So it depends on how confident you are that this is a triangle correction and that it will turn and break after that. So those are the best spots. And basically, it's good to keep an eye on these particular patterns, I think. And if you see them, it could be a good, useful confluence to take a trade. Maybe not the only reason, as I said, you need a lot more experience before trading waves. There's only, way of trading. It's I think better to use it as a confluence tool. First, use it as something you want to test and practice first. Use other things to trade with. Then slowly upgrade it maybe to label and use it slightly more for your analysis. Then maybe think about trades based on waves and other things, trend lines, moving averages, and slowly build that up. That's how you can get better at that. Triangles are usually wave fours indeed. I think that, if I remember correctly, they could be wave Bs as well, or was it wave Cs? They could be some corrective pattern as well, of course. That within like the ABC correction, you have triangle patterns too. Or you have the expanded correction. Sometimes you have triangles too, right? With WXYs. So it's not only wave four, it could be a correction within the correction, if you see what I mean as well. That's also very possible. But look at the guidelines and rules of the Elliott wave, of course, to find out exactly which corrective waves could have triangles. I use waves for confluence, so I don't use it as a standalone tool. But if you really want to learn it in depth and use it as your main tool, then take it step by step. That's my main and key message. And if you want to learn and see more practical examples, of course, admiralmarkets.com is the way to go. Check out the website, click on analytics, click on wave analysis, and every morning you'll find my view on one of the majors in 2 time frames, 1 hour and 4 hour chart. So feel free to take a look at that. If you're looking at admiralmarkets.com anyhow, you can check out MetaTrader Supreme Edition, a lot of extra features and the indicators and tools added to that special plugin from Admiral Markets. You can find out, of course, information about how to trade, start trading, the instruments, how the platforms you can trade, and extra analysis and education. But in general, yes, indeed, Dushan. I mean, triangles are, quite regular for wave fours, indeed, or flats, sideways moves like the euro dollar now, etc. All right, that's about it. I don't see any other questions, so I hope that helped. But feel free to reach out after this webinar to send me an email. You should be able to do that after the webinar. If you're looking at the recording on YouTube. You can join a live webinar, education, forex and CFD webinars with myself. In that webinar, you can be able to send questions like that as well if you wanted to reach out about these topics, or you can leave a comment below the wave analysis as well. And I think that should be possible. Oh yeah, I'm not in the article, but when you go into the article, you should be able to leave a comment. You can ask like that as well. All right, that wraps it up for today. Thanks for joining. Appreciate it. I'm a big fan of waves, but in a practical way. That was my main message. So hope that helps, and wish you all good trading. Cheers.